Gold obviously has broken out to new highs. Silver has a long ways to go to get to highs, but it is, moving above some significant resistance levels. Commodities are going to go through the roof. I mean, gold can go to 20,000, silver can go to 500, copper through the roof. Oil can go to 500. So, I mean, there's opportunities in areas of the market, just not S&P indexes.
DavidHunter, Chief Macro Strategist at Contrarian Macro Advisors, to delve into his expert analysis of upcoming stock market movements. He provides a comprehensive outlook on the anticipated shifts in the market over the coming months and quarters. DavidHunter discusses his bullish outlook on gold, predicting a price of $20,000 during a global bust. He also believes that the dollar could be headed lower, leading to a significant increase in the value of most currencies, including the yen, euro, British pound, Canadian dollar, and Australian dollar. However, there will be a reversal during the subsequent bust, with the dollar potentially reaching or exceeding previous highs. Silver, described as a poor man's gold, is expected to significantly increase in price due to increasing demand from industries like electric vehicles. Hunter forecasts a target of $60 per ounce and a potential run to $500, but warns of a painful bust in between. Hunter predicts an economic downturn more severe than a typical recession, driven by historic levels of global debt and derivatives leverage, the lingering effects of the pandemic, and central bank policy error. He encourages investors to protect their assets with treasuries and potentially the US dollar during this time. The commodities supercycle will be triggered by the immense amount of money required to stabilize the financial system during the bust, with significant price increases expected for various commodities, including gold, silver, oil, and industrial metals. Industrial commodities are expected to drop off before precious metals, and bonds will be one of the worst assets in this environment. Hunter emphasizes the importance of being an active investor and understanding market shifts, with a focus on the US, India, and resource-rich countries during a global bust. He is known for his big-picture macro perspective and early identification of market trends. We will present clips from DavidHunter's interview, but before we do, if you want more videos like this, please hit the subscribe button and turn on the notification bell for more updates. Thank you and enjoy the video.
I got beat up pretty bad for a while because I remained bullish through a pretty rough time in the metals. Basically, it looked to me back in the spring of 2022 as if they were going to break out, and then the dollar went the other way in a big way. I mean, we had a big climb in the dollar over the next 6 months, and the metals went south. And so it wasn't until basically fall of 2022 that we finally bottomed in metal. September fall in the miners, but September, October, or somewhere in there. And we've been kind of battling our way back since then. They really started to pick up speed fourth quarter last year and into this year, and have now really established themselves in a new bull market. And gold obviously has broken out to new highs. The silver has a long ways to go to get to highs, but it is, moving above some significant resistance levels, like the most recent one being 30. I think your next stop on silver is probably 35, 36, pretty short term. Could move to 38 and just move right through that. And then ultimately, I have a call for silver of $60. And I've said of late, it's 60, but if we get through 60, we could see 75 very quickly. And on gold, which is 2350, 400, I think 3000 pre-bust. Now we'll talk about what pre-bust means later, but and basically this year I think you could see 3000 on gold, and I think that number is going to probably be conservative. So they're both definitely in gear right now in a bullish mode with a lot of upside ahead, and even more upside ahead for the miners that move up when they move. I have pretty aggressive targets for all of them, and they're long. I mean, I've long held targets, but I think they're going to be realized this year. I see GDX going up to 65, GDXJ to 100, SIL to 75, and SILJ to 35. So there's some big moves there. And again, my belief is people are way too short term in this stuff. And what they have to realize, I mean, I I tell them at the bare minimum, look at weeklies because,
Yeah.
The action in the last 2 days feels very bearish until you look at it on a weekly and you realize, it's higher highs, higher lows. It's not,
Yeah.
it's nothing more than that. And the market has to keep cleansing itself. And, if it burns itself out, it's not going higher. So
Yeah.
these stair steps are a process of building that wall of worry that allows it to continue. And we've got a long run to go, so it needs that big wall of worry. And obviously, from a fundamental standpoint, people get nervous. Maybe some of the sell-off is because they think that, if equities go up, they have to go down. The metals miners have to go down, but that's not the case. I mean, I think we suffer from recency bias an awful lot of the time. So
DavidHunter discusses the current state of silver and the potential future performance of silver. He acknowledges that silver has disappointed since its last all-time high in 2011, but he believes that essential support lines have been reached both technically and fundamentally. With the increasing demand for silver due to the rise of electric vehicles and other industries, Hunter forecasts a significant increase in silver's price, predicting a target of $60 per ounce and a potential run to $75. However, there will be a painful bust in between, and investors should know there won't be a straight line to these prices. Hunter also discusses his reasoning for a coming global bust, driven by excessive leverage and the potential for governments to react too slowly. He encourages investors to understand the risks and consider asset categories that can provide shelter during this storm. An economic downturn will be more severe than a typical recession. This expected downturn to historic levels of global debt and derivatives leverage, the lingering effects of the pandemic, and a central bank policy error. Hunter warns that the bust could begin before the end of the year and last through 2025, with potential losses in the U.S. equity indexes reaching as high as 80%. He emphasizes the importance of protecting oneself during this time and encourages investors to fight their emotions as the market reaches new highs. Let's get back to the interview.
I think whereas we pumped up 5 trillion, increased the balance sheet by 5 trillion in 2020, I think this time it goes from 8 or 9 trillion to 30 trillion, so 20 plus. And proportionally, you see every central bank doing the same thing. That doesn't, initially, I think the bust creates deflation temporarily for probably less than a year, and so in deflation, that's why they are allowed. They have the ability to print that much, is because in deflation you almost have infinite ability to print,
right,
because of the lag to when that will become inflationary. I think the lag's typically 18 months. It could be more or less than that, but that means by the second half of this decade sometime, we're coming out of a hole. So we're coming out of negative inflation. But by 26, you're probably mid-singles to high singles. By 27, you're probably double-digit inflation. By 29 or 30, you're probably 25% inflation. So you create hyperinflation, but the lag you can't predict that. At least the Fed's not going to be focused on that when they're trying to save the system. But that's what we're headed for. And in that kind of environment, fiat currencies are going straight down. I'm not sure about, because obviously when you talk about the dollar, it's the dollar versus others. So versus the dollar, other fiats may be going up. Versus dollar, we're going to be hit the hardest cut probably because we're the one pumped the most,
right,
et cetera. But I think all fiats are in trouble. You can take this scenario and obviously interest rates track inflation. If I'm talking about 25% inflation by the end of the decade, I'm talking about 15 or 20% interest rates by the end of the decade. That monetization, that 20 trillion in new money, is monetizing debt. So we'll get something close to an equal amount in new debt, expanding our debt by another 20 trillion, government, U.S. Treasury debt. And so we're going to be looking at, massive debt that has to be serviced. We can't service it at 5%. How the hell are we going to service it at 15 or 20%? So ultimately, I think it comes to a 2030s, and I don't say 2030, but sometime in the 2030s, probably first half of the 2030s, we reach a point where the government's bankrupt, Nobody wants our debt. Nobody wants anybody else's debt because the rest of the world is doing the same thing. And basically, you can't service your debt. The Ponzi scheme comes to an end, and we collapse. I mean, to me, that's the end game here. As I say, I don't endorse what I'm saying is going to be the response to the bust. I'm just telling you what I think is the almost inevitable events that are coming. Yeah. So it's not a pretty picture ultimately, but what I think what people should take out of that is that get your house in order this decade, because what comes after that is pretty god awful. And those that have any chance of surviving are those that are going to be probably free of debt and have built their wealth. And there is going to be a huge commodity cycle. Stock indexes will not get back to their highs or anywhere close to them, I think, after the bust. Commodities are going to go through the roof. I mean, gold can go to 20,000, silver can go to 500, copper through the roof, oil can go to 500. So, I mean, there's opportunities in areas of the market, just not S&P indexes.
The upcoming commodities supercycle and the expected price increases for various commodities, including gold, silver, oil, and industrial metals. Hunter explains that decades of underinvestment in commodities have made it harder to find new sources, and the demand for these resources will be substantial due to industrial building, reshoring, and nearshoring. Additionally, the politicization of energy and the shift away from fossil fuels will create a supply shortage. The consumer will face inflation and potential economic hardship during this industrial and commodity-driven cycle, which is expected to be reminiscent of the 1970s and early 1980s. Despite his bearish stance on energy space in the near term, Hunter anticipates a significant increase in gold, silver, and oil prices, potentially reaching $20,000, $500, and $500 by the end of the decade. What are your thoughts on David Hunter's price prediction? Please share your thoughts in the comment section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. See you in the next one.